Robert Omo today, the head of research at AfriInvest, is choosing a day when the market has turned bullish to appear here once again on Business Morning, and it's good to have you. Thank you very much. It's good to have you when the market turns green.
Yeah,
perhaps the whole climate yesterday was about going green globally. So the stock market turned from red with a very solid green. So give us your take. Do you think the storm is over for this market bleeding?
Well, in the equities market, you can't really say when the storm is over, but there are factors to look at, but perhaps the movement in global equities also suggests to us the much of connection that we have, when you talk about financial integration, and how capital flows from different markets. We've seen that the consistent drop we saw in the market, for about 11 days before we saw that upturn on Monday, and going into Tuesday, speaks of the sort of weak appetite that foreign investors or investors have for emerging market assets, and Nigeria has not been excluded from that. We took our beating, but it was clear the market was set for a rebound, and that was what we saw on Monday and Tuesday.
When the market goes on a bit of a tailspin, as it were, what do you look at for? Fundamentals, isn't it?
Well, fundamentals is one thing to look at, but fundamentals are always there. Companies' fundamentals don't change drastically, and it takes time before the fundamentals change.
Unless they're closing shop.
Well,
or regulators hit them with something.
Yes, except the regulator is coming with a shock to the market, or the company publishes a number, or there is a policy out there or a mishap that will have any significant implication on their numbers.
So speaking to the macro fundamentals.
Yeah, macro fundamentals for now appear very sound, even though we are not where we should be. When you analyze the macro data from what we have currently relative to what we used to have.
In terms of the state of the economy.
Well, the state of the economy, it's always something that comes to the front burner, But again, without going into how well the government has performed, there is stability in the macroeconomic space, and that's one thing, to look out for. So within the macroeconomic space, there are no major triggers, that should get investors panicky, except, of course, the anticipation of the 2019 general election. So macro stability, we could say we have macro stability in the system as we speak, but generally what investors we want to look at, especially for investors that are not long-term, players, they would want to check when is the appropriate time to, track the market. So market is going down, fundamentals may look good, comparison with other markets may suggest that you're undervalued or underpriced. Investors want to catch in on such opportunities to be able to ride the curve when the market is about to turn, and that's what we are beginning to see.
We're getting to half time, which is the first 6 months of the year.
True.
So you think it is time for institutional investors to begin to look at their portfolio and whatever mutual funds or fund managers at half year say, look, it hasn't been a pretty year so far, at least from February to date. Perhaps we need to put some strength behind the market so that at half year look a little bit good, because you're not too sure what the political environment will be, of course, from July.
Definitely we had our worries, when we were looking into the year 2018. We had advised a much more cautious strategy for the half year.
First half or second half?
For the second half of the year,
That was your projection?
That was
your suggestion?
And that was our suggestion for the market at AfriInvest. But again, I don't want to be the carrier of bad news, but I do not think that we are going to see the institutional investors you mentioned coming big into the market, especially as we proceed into the second half of the year. These are the issues, we see what is currently playing out in the market in terms of the much of participation. By far, the massive or the biggest institutional investors, or if you like, fund managers in the market, are the PFAs. Analyze their performance, their play in the market relative to the entire size of the market. When you check for the bonds, 49.9% of FGN securities are held by these so-called PFAs. The data gets more scary when you're checking the corporate space. The corporate bonds are held almost 100% by PFAs. To be specific, But when you drive down the data you know, even the recently issued FGN, I mean, green bonds, you know, and even the Sukuk bond, they are significantly subscribed by these institutional investors. But on equities, they are 5%, you know. I mean, there are new regulations by PENCOM on the multi-fund structure, which should allow them to be much more participatory, if you like, in the what you call variable instruments, you know, unlike the fixed income.
Mutual funds.
Yes, variable instruments like such as equities, you know. Now, the point I'm trying to make here is that even though, you know, you make mention of something around the macros look good, the company's fundamentals are beginning to change to the positive, you know, but you see institutional investors here in Nigeria taking the back seat, only waiting for foreign investors to come and move the market before they join. You know, I mean, as much as we know that, for example, the PFAs are managing funds, you know, of retirees and, you know, every other person, the stakes are high, you know, but notwithstanding, when the market is clear on fundamentals, you know, we should be able to take, you know, certain bold decisions to participate in the market. And what you're seeing now, again, is a reflection of how much of risk the fund managers are willing to take on Nigeria. But to balance the perspective is to say that what is the depth of our market relative to the fund size that they have to invest, you know, and that's why you see all of the, you know, ingenious products that are coming up with, you know, mutual funds, further deepening of the market by ETFs or, I mean, ETFs tracking equities, you know. I mean, these are issues to talk about. But for second half, we do not expect that investors will be bullish on equities. We expect that they will be much more cautious. Even foreign investors who appear to still be in the market, you know, but are just trying to watch. Clearly, market fundamentals are good, you know, when you compare us to other markets.
If I'm long-term focused, yep, when should I get into this market? Would it be the second half when the rest of you who has made money in the first half have gone home?
You know, clearly speaking, there are always opportunities to make money or to, you know, make capital gains in the market, you know. So timing is very crucial. Look at what we have currently. If you look at the 11-day of losses that we recorded, which culminated to about 10.2%, you know, of losses for the 11 days. You saw market year to date slipping into 3.7% negative, you know. Some investors are already beginning to look at this. Within the 14-day window, you know, the technical indicator of 14-day RSI went as low as 7. And as we speak, we've had 2 days of positive gains, and this is still within the negative. Yes, the 14-day RSI is still below the overbought. Oversold region, which shows that there are much more opportunities for significant upside in the market. However, you have to be sure of which securities you're getting into, you know, so you have to analyze on a sector per sector basis, you know, without going, you know, mentioning names specifically. You see banks that are trading, you know, currently below what you could say is the short to medium term pricing or valuation in terms of price to book. I mean, these are clear cases of opportunities.
So let's do banks within the time we have.